I love HSAs personally. It is the best tax account that you can actually have because there's a triple tax advantage. There's a tax deduction when you contribute. It has tax-free growth, and the withdrawals are tax-free if they're for qualified medical expenses. So it's one of the only accounts that there is with all three tax benefits, a tax deduction now and no tax later. Hi, today we're going to be talking about the third most commonly missed tax deduction that I see, and that is the self-employed health insurance deduction and the health savings account, the HSA. So the HSA is one of my favorite deductions because it saves you money today and it also helps you build wealth for the future. So me and Emily talk a lot about that, building wealth for you and your family now. So the mistake number one is not deducting those self-employed health insurance premiums. So business owners are usually able to deduct their health insurance, their dental insurance, vision insurance, qualified long-term care insurance, and this reduces their taxable income, but you have to do it correctly. A lot of people get hung up on this because it's a little bit technical, but if it's done right, you're able to take this deduction on your individual tax return. The self-employed health insurance deduction, it is not a business deduction on your business return. You won't see it on the S-Corp return, but instead you'll see it on your personal tax return under the adjustments section. But you need to make sure that you're working with a bookkeeper or a tax preparer that knows how to do this the right way, because they're going to work with your payroll provider to make sure that this is reported correctly on your W-2 and also reported correctly on your tax return. If this is missed, this will be included in your income. It won't be a deduction, and this could be thousands of dollars that you're missing out on every single year. So the next mistake that I see with taxes is people do not open an HSA, a health savings account, when they're eligible to do this. So there are a few different rules, but you have to be enrolled in a high deductible health plan, an HDHP, in order to open a health savings account. So a lot of times people will get their health insurance through the state or the health insurance through the marketplace, and they think that they qualify for an HSA, but they don't. It has to be a high deductible qualified plan. So if you're looking for health insurance, before you sign up for anything, make sure it's a plan that qualifies you to open an HSA account. So I love HSAs personally. It is the best tax account that you can actually have because there's a triple tax advantage. There's a tax deduction when you contribute. It has tax-free growth, and the withdrawals are tax-free if they're for qualified medical expenses. So you can invest the money that you contribute. It'll grow tax-free. And when you take it back out to spend it on medical expenses or prescriptions, drugs, pharmacy, that type of thing, it is tax-free. So it's one of the only accounts that there is with all three tax benefits, a tax deduction now and no tax later. You're also able to treat it as a retirement account when you get to retirement age if you want to start taking out the cash that was invested from when you were younger and you don't necessarily have medical expenses that you want to spend it on. You are able to take it out. You'll just have to pay tax on those withdrawals if they're not spent on qualified medical expenses, but still, then it's just treated as an ordinary retirement account, which is great still. Another trick that people do, a lot of people in the FIRE groups, the financial independence, retire early groups, They are super crazy about retiring as soon as they can and building as much wealth as possible early. But what they'll do is they'll max out their HSAs every year. They'll put them into investments. And then when they have medical expenses, they save the receipts for those medical expenses now. And they let the money in the retirement accounts grow. They never withdraw from it to cover medical expenses because they're able to reimburse themselves later for those medical expenses that they had early on. So they take pictures, they save all of their receipts for out-of-pocket medical, and then they continue to let those retirement accounts grow and investment accounts grow, and they reimburse themselves later on down the line when they want to take the cash out. So that's a interesting trick. So a lot of common mistakes that we see with the HSA accounts is choosing the wrong health insurance plan just to get an HSA. Don't pick out an expensive health insurance just to get an HSA account because the juice won't be worth the squeeze. It has to actually make sense to you and your family. A lot of people will also contribute more than the annual limit. And the IRS will jump on you fast if you do this because you do get a tax form for your contributions that you put into the HSA. So if it's above the limit, you will get a notice and you'll have to take out that amount and pay a little bit of a penalty. Another mistake I see is forgetting that employer contributions count towards the limit, not your actual contributions. So if your employer is contributing towards your HSA as well, or incentivizing you to contribute and will match, etc., their contributions count towards the max that you can do for that year. So make sure you're looking out for that. And then the biggest mistake I see people make, and I see this all the time, is putting money into this HSA, but letting it sit in the cash account and never actually logging in to your HSA bank and investing those funds. So you need to make sure you're moving that cash that you contributed through payroll or whatever it was and put it in the HSA investment account so that it starts making money for you. Don't forget about this and don't be lazy about it. Actually move that cash or set it up to auto transfer the cash every single month into those retirement accounts. So if you're listening to this podcast today and you want to know if you are taking advantage of your health insurance premiums correctly, if you are deducting them right, make sure you ask your CPA or your bookkeeper if they are reporting those self-employed health insurance premiums the correct way and that it's showing up as a deduction on your individual return. Ask them to explain it to you, and this will show if they know what's going on and that it's being reported the correct way. It should be reported in box 1 of your W-2 wages. So it's going to be reported in income, and then you're also going to have a deduction on your individual tax return for this amount. And you can also ask yourself if you're eligible for an HSA, a health savings account. Do you have a high deductible health insurance plan? If you do, you should definitely open an HSA. If you are covered by health insurance through the marketplace or through a subsidy, you most likely aren't qualified, but it is beneficial. It would be beneficial for you to look into this. And then thirdly, you need to make sure your HSA account is actually invested and it's not just sitting there in cash, because that would be a huge loss for you. You wouldn't be taking advantage of compound interest, and you're really going to be kicking yourself in the foot when you're older if you just left that sitting in cash. So a lot of people think of an HSA as a medical spending account, but I think of it as a retirement account that also happens to pay for healthcare. If you have any questions about this, about deducting your health insurance or setting up an HSA, send us a message. We'd love to hear and help you out.